definitely been a better year this year for the New Zealand market. We're up 11% year to date as we speak, and if things hold, this will be the best annual performance we've seen in the past 4 years. So that's a bit of a relief for investors who have, over the last couple of years, stuck with some pretty tough returns. And this all comes despite the economic backdrop, still being pretty weak overall. If you think about GDP, unemployment, the property market, retail sales, everything is still pretty weak. I guess the big divergence you got now is that while those current conditions are looking weak, the future expectations are much more positive, and that's really been driven by falling interest rates and the fact that inflation is looking to have been tamed and is certainly back in the Reserve Bank's target band. So definitely that divergence at the moment between what we're seeing right now and what we're expecting over the next, say, 6 months. But I guess the market has moved ahead of expectations that the macro backdrop will soon start to reflect the benefit of those falling interest rates. So the Reserve Bank last week held its last meeting of 2024, and they elected to cut interest rates by another 0.5% or 50 basis points. So if we think back since August, the Reserve Bank has cut a total of 125 basis points or 1.25%. That takes the OCR from its peak, which was 5.5%, to today we're at 4.25%. If we look ahead to next year, the market is still expecting another at least 75 basis points or maybe even 100, so another percent potentially of cuts to come over the next 6 months. And that would take us to somewhere in that early 3% mark. And I guess, again, thinking back to the peak where we were 5.5%, we're looking at an OCR that's probably 2% lower than that peak. And remember, that peak was the highest level we'd seen in 15 years. So it was really putting the brakes on the economy. And now we're starting to see those brakes get eased off, and potentially over the next 6 months, a year, we might even see a little bit of acceleration for the economy as those rates go to neutral and potentially even lower. I guess the expectation is these cuts will stimulate the economy. It'll take pressure off borrowers. And at the same time, you've got moderating inflation, which means those of us as consumers, but also businesses, it's easing some of that pressure around costs and so forth. So overall, it should be a more prosperous backdrop for consumers and businesses as we head into next year. Yeah, still a little bit of a mixed bag in terms of results from companies that reported through this November period. The likes of Serco, Gentrack, Sanford, Turners all had positive releases, and nice to see that some of our smaller companies are performing well. Good for the health of the overall NZX50, because obviously these smaller companies, as they grow, become our larger ones. And we talk about the tough domestic economy, but remember the likes of, just as I mentioned, Serco, Gentrack and Sanford. Turner's a little bit of an anomaly, but those other three, they sell a lot of their products offshore, so they're less impacted by what's going on in the domestic economy, which has been weak. For example, Sanford, 80% of its sales come from places outside of New Zealand. So, do they mind what's going on in the domestic economy? Yes, to some degree, because obviously they catch a lot of their fish here. So, some of those impacts around wage pressures and insurance and those will impact them, but ultimately they're selling to offshore markets. So the domestic economy or the health of it is less important to the likes of those companies. Then I guess when you look at the ones that are a bit more domestically exposed, the likes of Steel and Tube, Kathmandu, Kiwi Property Trust, they did report weaker numbers, and that is reflective of what we're seeing day in, day out in the economy at the moment. If I think about the general themes that are coming out from companies across the board, it almost feels like they're the same from everyone. Things are currently tough. Demand is not that strong. But performance has stabilized from, say, a year ago. So things aren't getting any worse from here. Some of those cost pressures are easing, like labour, some of the input costs, but, others are still there in terms of insurance and so forth. We'll obviously start to see debt costs ease as interest rates come down. So the debt servicing costs of these companies will start to come down a little bit. As I mentioned, that demand hasn't really picked up, but we expect over the next 6 to 12 months that it will. And that's really the crux of, I guess, the positive bit of news coming out of a lot of these companies is things are tough, but they can see a pathway to a better 6-12 months ahead, as the benefit of the rate cuts that we're seeing at the moment and the rate cuts we'll see into next year flows through to consumer pockets, and they start to feel a little bit wealthier and start to go out and spend. And also businesses will start to feel more positive about themselves as they see the first signs of increased spending, and they'll start to invest in their businesses again, which ultimately will be positive for the broader economy. Yeah, I'm definitely the glass half full as we track towards this Christmas period and into 2025. We've definitely had a tough couple of years in New Zealand, both in terms of the economy and in terms of listed markets. But I can certainly see a path to improvement into 2025. And if you think about some of the positives at the moment for New Zealand Inc., dairy prices are strong. We could get the first ever $10 dairy payout from Fonterra. General commodity prices are pretty strong across the board. Yes, input costs have risen, but the prices that we are getting for some of our key exports are improving, which will help New Zealand Inc. and the rural economy. Our currency is weakened, which will again help exports. It will certainly be a headwind for those importing things into New Zealand, but overall, as an export nation, that will be good for us. Businesses and consumers will see that relief I've talked about from falling interest rates. The property market, bit of a mixed bag. It started stabilizing. It hasn't taken off, and I don't expect it will in the very short term. But just that confidence that things aren't falling from here for homeowners and mortgage holders will be positive. It's not without risks. There's always risks out there. That includes the potential tariffs from the US from a Trump administration when they take control early next year. But remember, there's never a time in markets, whether it's domestically or internationally, that there's no risks out there. So it's part and parcel of you've just got to accept that there will be some positives and negatives in markets at any point in time. I guess. Yeah, even with the lift we've had this year, we're up 11% year to date for the New Zealand market. We're still below the levels we saw in 2021, the immediate post-COVID highs that we got. Compare that to the US, Australia, lots of different markets. All of them have broken well through those highs. So, from a starting point in terms of valuations, we don't look overly stretched compared to some of our international peers. Part of that is because we've had a tough economy and a slow economy relative to theirs, but it means as a starting point for investors, things aren't overly stretched and looking a little bit tough. Rates will be lower, which will no doubt drive some more people that have been parked in term deposits and cash into sort of risk assets like equities, like housing and those sorts. And just to put some context around that, household term deposits in New Zealand are up to $140 billion now. That's more than the entire value of the NZX 50. So there is a lot of cash sitting on the sidelines. And as interest rates fall, we think some of that will be put to work and drive some of the valuation and demand for assets such as equities over the next 6 to 12 months. So we're positioning for that. Overall, our portfolio is still sticking to quality, still got that defensive bias because we think in terms of earnings in the economy, the next 6 months will still be a little bit tough as the benefit of those interest rates flow through. But once that fully is reflected in the economy, I think you'll start to see some of our more economically sensitive companies start to do a little bit better, the construction sector, retailers, those sorts, and we'll be positioning for that as the year progresses next year. Finally, I think the February reporting season, that's going to be our next barometer of what's going on in New Zealand Inc. for listed companies. That will be that two-step that I talked about very early on in this video, where the reflective of what's going on in the economy at present or in February will still be a little bit tough, but the outlook statements, I think, will become increasingly positive, and that's what investors will start to focus on, is who is now looking forward to those interest rate cuts and seeing the first green shoots of demand. And I think those will be the companies that get supported throughout 2025.